Before I get into the 2024 TSP updates, I want to show you some good news for many of you working for the federal government. Congress actually passed something and had an agreement. The House of Representatives, who made numerous tries to elect the Speaker of the House last month, just passed the National Defense Authorization Act, or NDAA, for 2024, which will give an impressive pay raise of 5.2% for military members and federal civilian employees. I'm going to show you the TSP update in a little bit, but I want to show you this really quick. According to Senator Kramer from North Dakota and his Senate Armed Services Committee, or SASC, voted to advance the NDAA for fiscal year 2024 out of committee. Not only will the military service members and the federal civilian employees will get a 5.2% pay raise, but the DoD will receive $886.3 billion in funding for fiscal year 2024 for national defense. The rest of the statement is about North Dakota because he's a senator from North Dakota, so I'm not going to read the rest of it. If you compare the 5.2% pay raise from the previous 2 decades, this is by far the largest increase in the last 22 years, and it's the biggest pay increase since 2002 under President Bush when they raised it by 6.9%. And this is definitely good news for the people serving in the armed forces and civilians working in the federal government. The only thing we're going to have to wait for right now is for Congress to sign the budget before November 17, or the government is going to shut down again. However, if the NDAA is signed without a budget, the 5.2% pay increase will still take effect starting on January 1st, 2024. So be sure to check out the 2024 DFAS pay charts as soon as they become available. But anyway, here's some major updates to the TSP. And keep in mind that some of them have already taken effect in 2023. The first one is waiving your 10% early withdrawal penalty for public safety employees, even if you haven't reached age 50 when you separate or retire from the federal service. This is under Section 329 of the Secure Act 2.0. So under Secure Act 2.0, if you're a qualified public safety employee or a P-coded employee by the federal government, your TSP distributions won't be subject to the 10% early withdrawal penalty if you're separated from service and have 25 years of service under the plan, even if you haven't yet reached age 50 when you separate. Most of you watching this should already know if you're designated as a P-coded employee. If you're a federal firefighter, a law enforcement officer like FBI, a Customs and Border Protection officer, a medical service professional, or an air traffic controller, you should have been informed by your agency or department that you have the P-coded designation on your TSP. This is important to know because your retirement planning is going to be much different from the other federal employees. You might be someone who joined a federal law enforcement agency at the age of 23, and you're going to be eligible to withdraw from your TSP as early as age 48 after 25 years of service. And I've had law enforcement clients in the past where I had to explain the early distribution rules. So if you need to chat with me about your financial planning, you can schedule your first free session with me by visiting firesuccess.com/coaching. And I also give a discount to my private clients who served as first responders or military veterans. So be sure to check out my website when you get a chance. And starting on January 1st, 2024, your Roth balance inside your TSP is no longer subject to RMDs. And under Section 325 of Secure Act 2.0, Roth TSP will no longer be subject to RMDs prior to a participant's death. And this is good news for people who are looking to keep their Roth money in their TSP for the long term. But keep in mind that calculations for RMDs from spouse beneficiary participant accounts will still include the entire account balance, and any distribution from a spouse beneficiary participant account will still count towards satisfying the RMD. Okay, and since most of you have a balance in your traditional TSP, keep in mind that the age you have to begin taking RMDs from your traditional TSP increased from age 72 to 73 starting on January 1st, 2023, and then it will further increase to 75 on January 1st, 2033. So if you have a TSP with pre-tax dollars invested, you need to keep track of your RMD table by visiting the IRS website. And what's nice about Secure Act 2.0 is that they're reducing the RMD penalty from 50% to 25% of the amount not paid to you on time. the penalty is further reduced to 10% if you meet the conditions of Section 4974 of the Internal Revenue Code and you correct the RMD within 2 years. And I know most of you watching this doesn't apply to you yet, but if you have parents or grandparents who plan to live off of their TSP, you should share this information with them so that they don't get penalized by the IRS. And according to the OPM, OPM is also known as the U.S. Office of Personnel Management. They're basically the human resources department of the federal government. There are about 12% of 2 million federal employees that are over the age of 60. So this following rule might apply to you starting on January 1st, 2025. If you're going to be age 60, 61, 62, or 63 years old in the calendar year 2025, your TSP catch-up contribution will increase from $7,500 to $10,000 in those years. So if you're 58 years old in 2023, you should be aware that this new rule so that you can invest an extra $10,000 starting in 2025. Also keep in mind that $10,000 in catch-up contribution is indexed to inflation or 150% of the regular catch-up limit. So don't be surprised if the IRS increases the catch-up contribution limit from $10,000 to $11,000 by the time we get to the year 2025. It's going to depend on how inflation goes for the year 2024. But that $10,000 in catch-up contribution can be made in pre-tax or Roth dollars, regardless of your income in 2025. But starting in 2026, if you're at least 50 years old and you make over $145,000 a year, your catch-up contributions have to be made Roth inside your TSP. The $145,000 income limit can also be adjusted for inflation, which will be announced by the IRS every year. Just remember that the $145,000 income threshold is set for 2023. So 2026, it could be $150,000 or $155,000, depending on the inflation rate. But most of you watching this make less than $145,000 a year, unless you're at least GS 13, Step 9 in the DC area. Then you have the flexibility to contribute to either traditional or Roth for the catch-up contribution. But if you're getting promoted and start to make over $145,000 a year in gross income, your catch-up contribution will automatically move to the Roth TSP balance. If you're both a guardsman or reservist and an employee of the federal government, you're going to have two TSP accounts. You'll have to consider the sum of those wages to see if this new Roth rule applies to you. For example, if you make $130,000 a year from the federal government and you make $15,000 a year from being in the reserve or guard, that's a total of $145,000 a year. So your catch-up contribution can only be made in Roth starting in the year 2026. Another scenario is if you're a guardsman or reservist in the U.S. Armed Forces, and you also have a private sector job with a 401k or a nonprofit organization with a 403b, you have to combine both wages to determine if you're over or under the $145,000 income threshold. And some other news you should know is the annuity purchases starting in 2024. I personally don't plan to use the annuity option to take the TSP distributions when I retire, but if you're someone or you know someone who's going to retire soon, keep in mind that when you meet the requirements for an exception to the 10% early withdrawal penalty by receiving substantially equal periodic payments, the exception will continue to apply in the case of a rollover of the amount or an annuity purchase that satisfies the required minimum distribution rules. And the next one is the ability to roll your money from your Roth TSP to either a simple IRA or SEP IRA. This is more for people who separate from the federal service and become self-employed individuals or small business owners. This applies to me more than most of you watching this, but let me know in the comment section down below if you're also a small business owner. And as of October 20th, 2023, TSP is still not giving us the option to put our employer match or agency match to the Roth account. Secure Act 2.0 gives people the option to make their employer contributions or employer match converted to Roth during the plan year. However, TSP still hasn't announced that they're allowing people to put their employer match into Roth. As soon as the announcement comes out to allow participants to contribute the 5% employer match to Roth, I will let you know in the future video. And TSP also doesn't have an emergency savings account like the 401k does. I personally don't think it's a good idea to have or use any cash savings inside a TSP if it becomes available, because I think it's much more accessible with a high yield savings account. I have such a hard time getting a hold of anyone at the TSP anyway. So I have my emergency cash reserve saved with, say, Ally Bank or some type of high yield savings account that pays 4.25% in APY right now. So if I get into an emergency situation, I can take that money out at any time. The other provision TSP doesn't have is student loan matching. And Secure Act 2.0 allows employers to match their employees' student loan payments by contributing to their retirement accounts. I haven't seen any announcement from TSP about this yet. I doubt that they will do any student loan matching because they already have what's called a public service loan forgiveness program. But be very careful with those forgiveness programs because historically speaking, these loan forgiveness programs are not so forgiving. And I want to show you this article from the NPR in 2018. And NPR actually did a detailed report back in 2018 when thousands of complaints about a disturbing pattern with PSLF. And if you don't know what that is, it stands for Public Service Loan Forgiveness. And it typically takes about 10 years of serving in the federal government to have the student loan forgiven. But borrowers became ineligible for the forgiveness program after finding out that they had the wrong loan and the wrong repayment plan or the wrong employer. You have to really keep track of your repayments and make sure that what you're doing is correct. In 2017, 99% of applicants for loan forgiveness have been denied. I would hate to see that happen to you. The deal right now is that you serve 10 years in the federal service and then apply for student loan forgiveness. If you can pay it off in less than 3 years, then pay it off in 3 years. I'm speaking from my experience working in the public sector in the past. The government tends to move very slowly, and it can be a very frustrating process, especially when it comes to anything administrative. Holding on to a student loan for 10 years could prevent you from building your wealth for the long term. And if Congress does end up passing the budget, which I think they will, that 5.2% pay increase is going to be significant. If you can increase your TSP contribution by 2% in 2024, that can make a significant increase in assets when you hit your retirement age. That could also make a difference in retiring at age 60 instead of age 62. Maybe you could retire earlier if you start maxing out your TSP contributions in 2024. I didn't start maxing out my retirement contributions until 2017 when I was 30 years old. And 7 years later, it grew well into the mid six figures. And was it because of the bull market? Sure. But it was because I maxed out my contribution every single year so that I could make early retirement a possibility. And this has been another beast of a video, and I hope you got a lot out of it.